Welcome to a deep dive into the world of accounting for the extractive industries. Imagine a company on a quest for hidden wealth, be it oil, natural gas, or valuable minerals. This journey is filled with high-stakes risks, immense costs, and significant uncertainty. So, how do we, as accountants, auditors, and investors, make sense of the financial reporting for these early-stage activities? The answer lies in a crucial and often misunderstood accounting standard, IFRS 6, Exploration for and Evaluation of Mineral Resources. The purpose of IFRS 6 is to provide a framework for the financial reporting of expenditures incurred during the exploration and evaluation (E&E) phase. This standard fills a critical gap, as before its introduction, there was no specific international financial reporting standard for these activities. The scope of IFRS 6 is very specific and limited. It applies to expenditures incurred after the company has obtained the legal rights to explore a specific area, before the technical feasibility and commercial viability of extracting a mineral resource have been demonstrated. This narrow scope is a key takeaway. Expenditures on preliminary surveys, for instance, are not covered by IFRS 6. Similarly, once a company has a proven, commercially viable resource, the subsequent costs of developing and producing it are accounted for under other standards, like IAS 16, Property, Plant and Equipment, or IAS 38, Intangible Assets. This highlights IFRS 6's role as an interim standard. This is where IFRS 6 introduces a unique and flexible approach. Instead of prescribing a single method, it provides a temporary exemption from certain parts of IAS 8, accounting policies, changes in accounting estimates and errors. This allows entities to choose an accounting policy for their E&E expenditures. They can either expense all costs as they are incurred or capitalize them as an asset. When a company chooses to capitalize these costs, the standard requires that the exploration and evaluation asset be measured at cost upon initial recognition. This includes expenditures like acquiring legal rights to explore, topographical, geological, and geophysical studies, exploratory drilling, trenching, and sampling, costs related to evaluating the technical feasibility and commercial viability of extraction. The choice of policy must result in information that is relevant to the economic decision-making needs of users and no less reliable than other information. This principle of relevance and reliability is the guiding light for a company's accounting policy. An essential feature of IFRS 6 is the mandatory impairment test. Companies must assess their exploration and evaluation assets for impairment when facts and circumstances suggest that the asset's carrying amount may be higher than its recoverable amount. This is a critical step to ensure that the asset's value on the balance sheet is not overstated. What are some of these impairment triggers? The standard provides clear examples. The company's right to explore in an area has expired or is about to expire, with no plans for renewal. Substantive expenditure on further exploration is neither planned nor budgeted. The entity has decided to discontinue exploration in an area due to lack of commercially viable quantities of mineral resources. Sufficient data exists to indicate that the carrying amount of the asset is unlikely to be recovered in full from future development or sale. If any of these triggers exist, the company must perform an impairment test. The measurement and recognition of any resulting impairment loss must be done in accordance with IAS 36, Impairment of Assets. The E&E asset is written down to its recoverable amount, and the impairment loss is recognized in the profit or loss. To provide full transparency, IFRS 6 requires a number of key disclosures. Entities must provide information that identifies and explains the amounts recognized in the financial statements from their E&E activities. These disclosures include the entity's accounting policies for E&E expenditures, including the recognition of exploration and evaluation assets, the amounts of assets, liabilities, income, expense, and cash flows arising from E&E activities, the level at which E&E assets are tested for impairment. This information is crucial for investors and analysts, as it provides them with the data they need to assess the company's capital-intensive exploration activities and the potential for future returns. While IFRS 6 was initially intended as a temporary standard, it has remained a vital part of the IFRS framework. It provides a pragmatic and effective solution for a complex accounting challenge. It offers flexibility to an industry defined by uncertainty while ensuring that companies provide relevant and reliable information to their stakeholders. By understanding IFRS 6, you gain a clearer picture of how a company's quest for mineral resources impacts its financial health. Thank you for joining us on this deep dive. If you found this information